Robert Heller is a former Fed governor who served under the chairmanship of Paul Volcker and Alan Greenspan. He joins us now with a reaction to those FOMC minutes. Mr. Heller, welcome back to Bloomberg's Bottom Line. Happy New Year. Thanks so much for coming on.
Pleasure to be here, Mike.
Sir, you have heard some of what our economics editor Michael McKee and Zara Burton was telling us. The policymakers basically saying improvements in the economy not meeting the threshold for scaling back their plans for that $600 billion in bond purchases. What's your reaction to that?
Well, I think the economy will be improving in the first quarter and throughout the year. And one of the main reasons is that the money supply has been growing very strong and steadily since April of last year. So that will have an economic effect as we look forward. Quantitative easing was a Johnny-come-lately in that game.
Given the fact that you believe that to be the fact, is QE2 having then the desired effect?
Well, I personally think it's overshadowed by the increase in the money supply. The Fed is at the present time buying up almost the entire federal deficit that is being created, and that will hold treasury bills down. But on the other hand, as you finance the entire deficit of the federal government with printing more money, that means that inflationary expectations will also be on the rise. So the Fed is creating for itself a larger problem in the future.
Breaking down these FOMC minutes, and members of the committee saying that as far as we're marking the 2-year anniversary of near zero interest rates, the central bank reiterating its plan to keep rates exceptionally low, and again that language for an extended period. How much longer can rates be kept artificially low?
Well, I think there's a limit to it. Eventually people run out of patience. As the economy recovers, right now we already see increases in gas prices, increases in cost in the healthcare sector, in education. A lot of food costs are going up. So the inflationary pressures are building in the economy. The one thing that is holding it down is the housing sector. That makes up about 35% of the whole CPI. So on average, inflation is down, but you see the animal spirits coming up again, and the Fed can't hold it down forever.
Mr. Heller, when does that housing market start to turn around with the unemployment rate continuing to be near 10% and a lot more people now, instead of buying homes, they are in fact renting, some people in fact even moving back in with their parents? When does this start to turn around?
I don't see it turning around at all, unfortunately, because the baby boomers are just reaching retirement age. That will mean they will move from very large houses into smaller houses, into apartments, condominiums, eventually into retirement homes. And therefore, the demand for these large houses that we've been building will not be there for years and years to come. So housing will be a very subdued sector.
And that jobless rate that I just mentioned, near 10%, what we see here is that employers are still reluctant to add to their payrolls. But as you have pointed out to us in the past, we should mention that unemployment still remains a lagging indicator. So if we're not seeing employers adding to their payrolls, when does the jobs picture start to turn around?
Well, Mark, that's a very difficult question. It's a lagging indicator, as you pointed out just a minute ago, and therefore I think recovery will be very slow. We need a new vibrant sector. We need exports to help push the American economy forward and create new jobs. But that isn't really in the making at the present time. So I see continued trouble in the housing area.
Interestingly, though,
as well as employment.
It seems almost counterintuitive, because we are seeing people with more money in their pockets, and we are seeing people start to ramp up on some of their purchases, some big ticket items like automobiles, for example. How do you compare the two?
Yeah, automobile purchases have been postponed, and automobiles are an asset that eventually will wear out. You can run a car for 6 years, run it for 7 or 8 years, but houses are there essentially for forever, for decades. So it's a very different picture. Automobiles, you have the replacement demand, but that isn't there in housing. And as I pointed out, there is the increasing push into smaller units into condominiums, into apartments, and all that vacates these large homes, these McMansions that we have had in the past.
Mr. Heller, we did see around the release of those minutes, we were taking a look at currencies, and our Dominic Chu was telling us we were taking a look at euro dollar, and that was at 133. What type of effect are these minutes having on currencies, and what effect will they have going forward?
I think it's very, very difficult, if not impossible, to predict currencies. It will not only depend on what happens in the United States, but also what happens in Europe. If another one of the European countries gets into trouble, it means the dollar will strengthen very strongly. If the Congress does not come to a budget agreement in the near future, doesn't take steps to reduce our debt, the dollar will tumble. So I think it's very, very difficult to forecast what the path of the currency will be. And, you know, you'd have to eat your crystal ball.
Former Fed Governor Robert Heller joining us from San Rafael, California, and kind enough to stay with us through the commercial break. Mr. Heller, it's always a pleasure to have you on. Thank you so much. Appreciate it.
Thanks, Mark.